This is Mike Reed with cEntellect, and welcome to this week's proprietary research and analysis. This week's topic is U.S. crude demand destruction. This is actually part two. Part one was 2 weeks ago when we looked at crude demand destruction not in the U.S. but in emerging markets. And that was primarily driven by currency devaluation driving up the price of crude in their local currency. That research piece implied between 500,000 barrels a day and 900,000 barrels a day of emerging market only demand destruction, again driven by currency devaluation led primarily by India. Let's fast forward to today. In this research piece, we're not looking at an emerging market, we're looking at the United States and what's happening here. Really three broad takeaways. The first is we see crude demand destruction in the U.S. at $66 a barrel. Above 66, demand destruction coming in at about 1% demand per $1.50 change in crude oil. Below $66 a barrel, we actually see demand creation. So the tipping point is coming in at $66. We also think in general, the market is overestimating demand and underestimating supply as a general rule of thumb. So that's why we're kind of harping on the demand side of the equation. The second bullet point I want to take away is there's been a lot of chatter, a lot of scenarios out there. What happens if the price of crude goes to $100? What happens if it goes to $200? I don't think those scenarios are sustainable because I think demand destruction will be higher than the market believes. There'll be two types of demand destruction. One is, let's just look at hybrid vehicles. If everyone in the U.S. drove a hybrid vehicle that averaged 45 miles per gallon, what would happen? Crude demand in the U.S. would fall by 45%. Electric vehicles is a little bit different. Electric vehicles, Tesla's currently pricing electricity as if that vehicle was burning gasoline at 40 miles per gallon. So a 45 mile per gallon hybrid would actually be cheaper to run than 40, but nonetheless an electric vehicle can also substitute as well. So my point is a combination of things, the market can find alternatives driving demand destruction. What I want to do now is let's talk about how we got to the $66. What we do at cEntellect is we do a bottoms-up demand table, and you can see the table here, and we're looking at all the components on the crude value chain and then the products value chain, both from products supplied as well as change in crude stocks, both in imports and exports. We add them all up and you can get this chart. This is the chart for actually close of business last Friday, which was October 12th. And what this chart told us is that the 4-week average U.S. domestic demand was 14.8 million barrels per day. And the same 4 weeks average 1 year ago, the reason we use 1 year ago is to deseasonalize it, was 15.1 million barrels a day. So we see crude demand down 1.8% year on year. The market has only recently started increasing the chatter about demand destruction. We've only seen this in the past 6 weeks. And they're really focused on 4 drivers of demand destruction. The first is weaker economic outlook globally. The second is trade concerns with the current trade wars that are occurring. The third is higher oil prices. Our caveat at cEntellect is higher oil prices and currency devaluation combined, not higher oil prices in and of themselves. And then the fourth is ongoing Chinese data revision. So these 4 things have increased the market chatter for demand destruction. But if you look at this table and you end up with a minus 1.8% year on year against current crude pricing, what we've done is we've gone ahead and looked at these tables over the prior year. And what we end up with is a chart that looks like this. This is U.S. demand destruction. You see the angle of the line. You see the tipping point it crosses right about $66 a barrel. In order to generate this chart, we looked at that table over the past year, and then we actually ran an optimization model because we know when crude price changes, we don't get instantaneous demand changes. There's a lag. What we found is the lag occurs on average between 4 and 41 weeks ago. So if crude price changes today, it's going to take 4 to 41 weeks before we're going to see the according demand change. And then what we did, and that is a period of 29 weeks for it to flow through the system. And then we looked at the optimization where the relationship peaked out at, and the answer is over the past 42 weeks. So you have 42 dots on this chart. The correlation is actually pretty high. It's minus 0.73. Sure, when crude price goes up, demand goes down, correlation of minus 0.73. The R squared is 0.53, and that implies some causality. It doesn't prove it, implies causality that price can explain 53% of demand. Something else explains the remaining 47%. This chart is probably different than conventional wisdom believes because most of the market chatter is it's not that significant a relationship. We're going to argue it is. Let me close out again with the takeaways. We see the tipping point at $66. As of today, crude's trading at 69. We think it's headed below 66, so we think demand destruction is going to ease and or get demand creation going again. We'll see if that happens. Keep in mind the market does have alternatives. It takes a while to work through the systems. That includes hybrids and electric vehicles. For this and much more information, please visit us at cEntellect.com.